Hello, everyone, and welcome back to the GMS Weekly Podcast, where we break down the key developments shaping the global ship recycling markets.
It's week 14 of 2026, and as we move into the second quarter, the market feels like it's carrying forward the same weight we saw through Q1.
That's exactly the right way to describe it. There's no real reset here. If anything, the structural pressures have become more entrenched. The geopolitical backdrop remains dominant, oil prices are still elevated, and the flow of recycling candidates continues to lag behind what the market actually needs.
And when you step back and look at the macro picture, it really comes down to one central issue: the ongoing conflict in the Middle East. That's still dictating sentiment across energy, freight, and ultimately recycling.
Absolutely. Brent crude has now held above $100 per barrel for 7 consecutive weeks, sitting above 109 this week. That's not just volatility, that's a sustained geopolitical premium. And when oil behaves like that, it feeds directly into freight markets.
Which then creates that familiar knock-on effect. Freight earnings remain strong, and owners continue to trade older vessels longer. So instead of seeing a natural flow of end-of-life tonnage into recycling yards, we're seeing a delay, and it's becoming a prolonged one.
And that's really the key macro takeaway again this week. The issue isn't demand from recyclers, because that's clearly there. It's the lack of supply. The Baltic Dry Index has softened slightly, but at just over 2,000, it's still far too firm to trigger meaningful demolition.
Exactly. Owners are still earning enough to justify keeping vessels in service. So recyclers are essentially waiting for a shift in freight economics that hasn't come yet.
Now layered on top of that is the currency story, which this week added another level of complexity, particularly in India.
Yes, the Indian Rupee rebound was one of the more notable developments. After hitting record lows, the central bank stepped in with a series of measures, tightening FX exposure, limiting forward trades, and restricting corporate rebooking.
And that kind of intervention has a real impact on recyclers. A stronger rupee improves their ability to bid for vessels priced in dollars, while their revenues remain in local currency. So structurally, that's supportive for a long.
But the broader currency picture is still far from clear. The US dollar moved in different directions depending on the currency, stronger against Turkey, weaker against India, and relatively stable elsewhere.
And that lack of consistency creates hesitation. Buyers and sellers can't anchor pricing expectations properly, and that slows negotiations. So once again, we have a market that is open, but not flowing.
Let's bring in the pricing table because while the rankings haven't changed, there are some subtle shifts worth noting.
Bangladesh remains firmly in the number 1 position. Pricing has edged up slightly, around $455 per LDT for dry bulk, $475 for tankers, and $485 for containers.
Pakistan holds second place, with indications at roughly $445, $465, and $475.
India follows in third, at $430, $450, and $460.
And Turkey remains at the bottom, slipping slightly further to around $265 to $285 per LDT.
So while the order hasn't changed, what stands out is the continued strength at the top, particularly Bangladesh, and the widening gap at the bottom with Turkey.
Let's start with Bangladesh because this is where the most consistent momentum is building.
Bangladesh is clearly the most active and engaged market right now. The post-Eid momentum we talked about last week hasn't faded. It's actually becoming more structured and sustained. Recyclers in Chattagram are actively looking for tonnage, yard space is opening up, and the overall mood is much more constructive than it was earlier in the year.
And importantly, the financing side is improving. The letter of credit bottleneck that slowed transactions through Q1 is now easing, with central bank approvals moving more efficiently.
That's a key development. Because without financing, appetite doesn't translate into actual deals. Now, Bangladesh is moving closer to converting intent into execution.
Steel prices have also edged slightly higher, which adds a bit more support to bidding levels. It's not a dramatic move, but in a market like this, even marginal improvements can influence sentiment.
That said, there's still a strong element of caution in Bangladesh, and it's coming from compliance concerns. The 2 OFAC-sanctioned VLCCs sitting at anchorage remain unresolved, now entering their 3rd week.
And that situation is having a lasting impact. Buyers are conducting far more rigorous due diligence, especially on vessels with unclear ownership or transaction histories.
So Bangladesh is operating in a very balanced space, strong appetite, improving financing, supportive pricing, but also heightened scrutiny and risk awareness.
And then there's the time pressure. The monsoon season is approaching, and that creates a narrowing window for transactions.
Exactly. With roughly 8 weeks to go, recyclers are under pressure to secure tonnage before conditions change. So Bangladesh is ready, but it needs supply to respond.
Moving to India, and here the picture becomes more mixed.
Yes, India saw some positive signals this week, particularly the rupee rebound and slightly firmer steel prices. On paper, those should support stronger bidding.
But in practice, those gains are being offset by operational challenges. LPG supply disruptions are now affecting steel mills in Alang, slowing production and weakening demand for recycled steel.
And that's a critical point. Even when currency and steel move in the right direction, operational constraints can quickly erode those gains.
Which is why India continues to lag slightly in pricing compared to Bangladesh and Pakistan.
And of course, the core issue remains unchanged: tonnage availability. Alang has the infrastructure, the compliance credentials, and the capacity. But without sufficient inflow of vessels, those advantages remain underutilized.
The HKC compliance story is still India's biggest strength. With over 110 compliant yards, Alang remains the most capable destination for regulated tonnage.
But that's a structural advantage. It doesn't solve the immediate problem of supply.
Exactly. Until vessels start arriving in meaningful numbers, India's position remains constrained.
Now Pakistan, where the tone is gradually improving and becoming more stable.
Yes, Pakistan is entering Q2 on firmer footing. Steel prices have held their recent gains, stabilizing around $627 per ton equivalent, and the Pakistani rupee has remained steady.
That combination creates a much more predictable operating environment for recyclers. And after the volatility seen earlier in the year, that stability is a significant improvement.
It also allows Pakistan to reestablish itself as the second most competitive destination in the subcontinent.
The compliance story is also moving in the right direction. With 3 HKC-certified yards now operational and more expected, Pakistan is gradually strengthening its credibility with international sellers.
And geographically, it continues to benefit from proximity to Gulf tonnage, especially vessels displaced by regional tensions.
So the fundamentals are aligning better for Pakistan: pricing, stability, compliance, and positioning.
But once again, everything comes back to supply. Without a steady inflow of vessels, even a well-positioned market can only do so much.
So Pakistan is improving, but still dependent on external dynamics.
And finally, Turkey, which continues to face structural challenges.
The Turkish Lira has weakened further to a new record low, and despite significant central bank intervention, the trend hasn't reversed.
And that has a direct impact on recycling economics. A weaker lira reduces the USD value of local steel prices, making Turkish offers less competitive on the international stage.
At current levels, around 265 to 285 per LDT, Turkey simply cannot compete with subcontinent pricing for mainstream tonnage.
The domestic steel market also remains weak, with limited demand from the construction sector and ongoing inflationary pressure.
Turkey does retain its niche, though. EU-approved yards continue to receive regulated European vessels.
But that's a very specific segment. It provides some activity, but it doesn't change Turkey's overall competitive position in the broader market.
So Turkey remains active in a limited sense.
But structurally constrained in the wider recycling landscape.
Before we close, the port activity reinforces everything we've discussed.
India saw some deliveries, including a larger offshore unit. Bangladesh had a couple of smaller arrivals.
And Pakistan reported no new vessels.
So once again, the physical flow of ships confirms the same story. Limited supply across the board.
So the core takeaway from week 14 is quite clear.
Q2 has opened under pressure, and that pressure is coming from macro forces that haven't shifted.
Bangladesh remains the most aggressive and engaged buyer.
India remains the compliance leader, but constrained by supply.
Pakistan is stabilizing and improving its position.
And Turkey continues to operate within a narrow, niche segment.
But across all markets, the central question remains unchanged.
Not whether recyclers want ships,
but when owners will finally decide to release them.
Because until freight softens or geopolitical tensions ease,
the recycling market will continue to wait for supply to catch up with demand.
That's all for this week's update on the global ship recycling markets.
We'll be back next week with more insights.
Until then, stay safe and see you next week.